to thank RIT, NTID for interpreting for us today. They'll be voicing for our presenter. And we have Rachel Green and Byron Beam. So thank you so much for interpreting for us today. I wanted to also go over a quick blurb on what SCORE is, because we're hosting this webinar for you to make sure that we can help you with your business. And so for over 50 years, SCORE has served as America's premier source of free and confidential business mentoring and education. As a resource partner of the U.S. Small Business Administration, the SBA, SCORE has helped more than 11 million entrepreneurs through mentoring, workshops, and educational resources since 1964. SCORE has over 300 chapters nationwide with a wealth of knowledge and experience to share and help you succeed in business. You can sign up. It is a national organization. And if you go to score.org, you can sign up for a chapter near you and get mentoring. So that brings us to our presenter. So welcome to Financial Wellness 101. Our presenter today is Rosemary Beyer. She's a financial educator, business director, and the founder of Deaf OIC. So I'd like to welcome Rosemary and thank you all for being here.
Wonderful. Good morning, everyone. Thank you so much for that warm introduction. It's so great to be here and be with all of you and to hear about all these wonderful opportunities that SCORE provides. Really looking forward to our attendees and participants using the SCORE resources in your businesses. So I'm very excited about that. Right now, I'm thrilled to be able to share with you about Deaf OIC. For those that might have never heard about our organization and financial education, like in the past, I was learning along with this and was really intrigued, and the financial education that's taught, or the lack of financial education that's taught in the school system. For those that think about how you learned about financial wellness. Was it in your K through 12 experience? Was it in college? For those that we could see, there's really not in a lot of formal education where we are taught how to use money. Schools, when we are thinking about 12 years of education, we're not actually prepared to handle money. And when we go to college, the same thing. And then we start off our careers with almost being on our own, and we're trained to be employees. And so how do we really take a hard look and get out of living paycheck to paycheck and that cycle that many of us live in and achieve financial freedom? Can I retire comfortably? Can I travel? Can I take vacations? These are so many big questions that we have. And through the pandemic, it's really shown a lot of us that we're not fully prepared in our financial well-being. When we think about job loss or illnesses or things that come up that our family is facing, the financial burden that we deal with can really rock our personal finance. So everything from physical illness that leads to maybe mental health illnesses, some of our sources of stress can actually be caused from a lack of financial health. And so this presentation today is called Financial Wellness 101. And I chose this name because it really addresses those foundational components of our well-being. And I wanted to share briefly about what's at the heart of Deaf OIC. So at Deaf OIC, our mission is to provide not only financial education in terms of concepts and education in terms of providing it in sign language, but we actually provide financial planning and connecting the two between financial service providers and individuals through American Sign Language. So we take an in-depth look at your personal finances and connect that with your goals and objectives. So as you can see, I'd like to share just a little bit about myself. I actually did not have a background in financial services. My skill in finance is actually in terms of spending money. Maybe some of you could relate with that, but for those like myself and previously didn't have a good idea of what it meant to invest my money. I actually my skill set was in natural birth. As a trained professional, I am a trained doula and provided assistance for natural childbirth. And I assisted over 800 births over 13 years. And the idea, or at that time, I understood what it was like to operate a business in that industry, but I didn't fully understand how to save for my retirement and taking that into my personal finance. And that's what actually propelled me to become a client of OIC, where I would actually learn about myself financially. It was a perfect time for me to look for a new career. And I wanted to spend more time with my 3 boys. And I also still wanted to help the community, the deaf and hard of hearing community. And I thought that this was the best of both worlds operating a business. So for the past 3 years, I've become a business director at our Infinite company. And I founded Deaf OIC 2 years ago. And we now have expanded to the Washington, D.C., Maryland, Vermont, New York areas, and Austin and Dallas areas as well, and Arkansas as well. So so many of those areas we are growing in. We're happy to be here with you today. And so, like I just shared, our mission is to be a large movement that consists of empowering our community through financial education. So we have a platform to help with financial solutions that actually help you take back control of your lives. So there are 3 questions that I wanted to present to you today that you can think about. Do you already have financial plans in place? Second question is, do you know how your financial plans work? And then lastly, have you had a financial planner, an advisor sit down with you to ensure your financial home is being built correctly? So at Deaf OIC, we offer a lot of opportunities to achieve that through American Sign Language. So right now, in our presentation today, we're going to be talking about financial health. And in that first question, have you had a chance to sit down with a financial planner? And most people have answered no to that question. And in fact, there's really no consideration for that. And it's clear to see through statistics is that only 56% of Americans have less than $10,000 saved for retirement. When we think about retirement, retirement is actually not a strong goal for American people. And I think some of the reasons for that is that the cost of living is high, the abilities to save is really low, or it's not as high of priority, or maybe we don't talk about that early enough. In our education, when we in our upbringing? Are we exposed to conversations, whether through adults, through other people? Most people in our lives might not be retired themselves. And so maybe for some of us, we believe achieving retirement is almost impossible. And so I wanted to share a few reasons. And number one of the reasons why people can't save for the future is their budget skills. Their budget skills do not allow for that, or they're weak in that area. And there's a rule called the 50-30-20 budgeting rule that I wanted to share with you. And I'd like to review that. And I hope that this is an opportunity for those that are following along this presentation to see how these numbers work in your current bank account and in your spending. So when we think about our budget, we need to allocate 50% to our needs. And our needs consist of our food, our housing, utilities, transportation costs, healthcare, insurance, and education. Maybe you're paying for college. That would be considered the needs category. And then also we can see that in this section, in our needs section, the housing cost itself, typically the housing alone achieves more than 50% of our household budget or our paycheck. And so when we think about why that is, I think it's because a lot of individuals can't live within their means. And so they have to evaluate, do I need this size of a place? Or when you think about, can I afford this amount of a mortgage or what I'm paying for living expenses? They don't know where their income is, and then being able to achieve less than 50% for their housing costs. So when you think about your monthly income and your housing costs, it needs to be below that 50% of your income mark. And secondly, in the other category, what we call the wants category, many individuals have no problem in this category. Now, we need to be able to spend on things that we want. That's actually part of a healthy cycle. It's not actually healthy to save for your needs and your future goals itself, and to actually compromise all the things that you want. That's not a balanced cycle. So it is good to reward yourself that after you achieve your emergency fund, or if you're setting your goals and working towards your goals for retirement, to actually enjoy spending things that you want. And that could consist of shopping, going out to eat at restaurants, different sort of amusement activities that you might enjoy. But please recognize that under the wants category, we label dining out, which is separate from in the needs category where we have food, which would be considered groceries. So just to make that distinction there between the two. When I sit down to meet with clients for a free financial analysis and just initially reviewing their spending, one of the first things that I notice is that they mix going out to eat with the food budget that they have that's supposed to be in the needs category. So one of the best tips that I can give as a financial planner is to print out a copy of your bank statement and use different color highlighters to go through and categorize the types of spending you have, specifically with grocery expenses and dining out. And you'll see pretty quickly an accurate picture of what those percentages are between your wants and needs when it comes to food. And historically, I've helped clients save on average $250 to $300 a month just by clarifying the wants and needs when it comes to food. And for some of you, when you see the savings goal to be 20%, you might laugh to yourself thinking that that's really hard to achieve. And some have a rule of maybe 10% for savings, which is understandable, but that's actually a misunderstanding. The 10% is for retirement alone. And then the other 10% of that should be towards your short-term goals to actually make up a total of 20% of your paycheck into savings. And so it also, those things can prevent accumulating future debt where you're not actually borrowing money from someone else, because you can actually use your own savings for things that you're saving for. And it also builds up saving for the future, for future events. So maybe you have a desire to start saving, and that could actually be one of your goals, where it actually, maybe you're still feeling the pain from 2020. So 2021 is the year where you can commit to starting your long-term savings, getting that emergency fund set up, getting those short-term goals clarified. So that's a rule that I use with our clients. And I also want to share with you a few concepts. On this slide, there's another concept called the X-curve concept. And this is basically, for me as a financial planner, to know the pathway to helping my clients achieve their goals. So what you'll see on the left slide is in a light purple line, typically represents age. The white line at the top represents your responsibilities. And typically, as we're younger, we have maybe less securities, and we're still working on increasing our income. We are working on paying off debt. That's a typical representation of when we're younger. When we're also younger, we're actively working because we're young, we have energy, we're ready to work hard. So in return, we have that income that we're building up wealth in our younger years. And at the same time, we also have a lot of responsibilities. We'll have a mortgage for those that have kids, saving or paying off college debt, credit card debt, maybe automobile payments. Some of us are in a sandwich generation, so where we're having to take care of our parents and also our kids, and we often forsake our own responsibilities, but it adds to our stress. So are you sweating at all those responsibilities that we have in our younger years? And this used to make me unable to sleep at night, thinking of all the responsibilities that I have and where is my plan and how can I be achieving that? And that situation actually helped me to being a client to start. So my role is to help clients now reduce the responsibilities before retirement. So, and at the same time, we also have to be growing in getting the interest from our savings, the money that we're saving. So we need to be able to see our wealth and savings accumulate. So as we're paying down our debt, hopefully there's an increase in the wealth and savings that we're striving for. And it would actually, in a way, we're making our money work for you. And one of the reasons for that is because if we don't figure out how to make money work for us, well, guess what? we will die working to make money. So for those, yeah, if you're thinking along, if you are living a really long time, maybe one of the questions is, have you saved enough? If somehow you pass away, did you have the proper protection in place? Or what about if you get sick? Do you have suitable living benefits in place?
So now we're just going to take a quick pulse. I want to check in and see the reflection of our group. I'm sorry, Rosemary. I'm sorry about that. Something moved my screen. So I'm just going to take a quick pulse here and just see kind of who we're working with. How old is everyone? How are your finances going so far? So Kristen, do you mind sharing that poll now? Wonderful. So go ahead and answer the polls. Click whatever answer is correct for you. It's anonymous. We won't have your name or any other information. Just wanting to know sort of, again, the pulse of the group. So the first question is, do you have an emergency fund? The second question is, do you know how much you need for retirement? How much will you need to invest? And have you met with a financial planner before? Wonderful. All right, so I'm seeing some good responses so far. Thank you all so much for sharing. I am really, really happy and proud to see so many of you are already saving. You all deserve a gold star. I don't ever think I've seen this many people that have an emergency fund. So kudos to all of you. You're already one step ahead. Okay, great. So I'm hoping that we can see the results from the poll once you've concluded with your responses. Wonderful. Here they are. Great. So we're working around the 50-50, about half and half range here, a little more, maybe 60-40. But it's really great to see the various perspectives, the mix of people, and sort of what financial planning you have set already. And there's no right or wrong answer. The best thing is that you're here and you're here to learn. And that's what we're doing today. All right, so let's continue. And let me close the poll really quickly. So I don't know everyone's ages in the group, but you do know your own age. So, consider your perspective and put it in a context for you with this slide that I'm going to talk about. So this is, based on some of the responses that I saw from the poll. When I look at millennials, when we look at millennials as a group, typically, you'll see the first category here on the top. So it's about 29.8% that have less than 10K saved, if you'll notice the key at the bottom. And 42% of them, millennials again, right, aged 18 to 34, they have no savings at all. They have nothing in their retirement. So this age group is the most likely to recover from something like that, from financial disaster, crises, etc. And young people tend to have the most chance for recovery because they have more time to work. And if you remember the curve, they're the most active workers because they have, that time to do so. So obviously we notice that the boomers tend to be the best savers with the lowest percent of them that don't have retirement. And why did it skip a generation? So again, back to what I spoke to in the beginning, educational institutes stopped teaching students about banking and checkbook keeping and balancing a checkbook and just financial wellness in general. And so we lost that opportunity through the generations. What? Okay. We have to really consider how to be most proactive on your own in considering your financial wellness and education. How can you approach your finances? How can you break everything down so that you understand how to best set yourself up for success? So again, you saw the different breakdown for the age groups and how they save for the future, but now we're wondering about why. Why do people not have retirement? And really the answer is that no one is safe. We have to establish retirement accounts like 401ks or 403bs, Roth IRAs, regular IRAs, etc. People do in general establish those accounts, but what happens is that most Americans tend to withdraw their funds from those accounts at some point too early. Perhaps a financial disaster occurs before their retirement, an accident of some sort, divorce. I mean, there's tons of reasons why a person might withdraw early from their retirement account. Sometimes people do it to pay off their debt, to pay down bills, etc. And so there's a lot of ways that people can end up with a lower balance. There are 11.9, thank you, unemployed people right now in the US. As we know, COVID's hit and it's been very difficult. Most of them have had to withdraw early from their funds because it's all that they've had. Of course, there's a more competitive job market now, and it takes about 1 year on average to get a suitable job once you've been unemployed. And that was before COVID. So now after a pandemic, we can absolutely expect a higher demand for new jobs. We see that happening. And how long will it take people to be reemployed? So it will take a lot longer now. So now we're going to talk a little bit about building a solid financial home. And what does that mean? So a lot of people, approach financial planning a little backwards. They think, oh, it's fun to invest, or it's fun to grow funds, interest, build up on funds, etc. But we have to make sure that we build on solid ground, right? If we don't have a solid foundation, then everything will crumble. So what we're going to do with this image is we're going to start at the bottom with protection, the base of our pyramid, if you will. Protection includes things like life insurance, health insurance, living benefits. And then as we move on to the second ring, we've got debt management. We talked a little bit about that before in terms of needs versus wants and making sure that there's a clear delineation among the two. The third ring we've got is emergency funds. And there's a huge need for that. A lot of people, again, with unemployment due to COVID and whatnot, they're not working, but thankfully they've had some backup money in savings, and that's been able to save them. But there are a lot of clients I have worked with who had to withdraw from retirement because they didn't have that emergency fund. And what exactly is emergency funds? An emergency fund. It's basically 3 to 6 months of your expenses that's easily accessible in a bank account for you. So if you're laid off from your job and out of work for a little while, or there's an unexpected medical emergency that occurs, or sometimes something happens, cars are always breaking down and they break down at the worst time ever, or your water heater busts and floods your house. You want to make sure that you've got enough money to get you through for a few months after a crisis. And then the last ring here is the investment at the top. So again, we talked a little bit about that 401ks, 403bs, IRAs, IRPs, which are individual retirement plans, mutual funds, stocks, and annuities, all encompassing. Those are investments. And we could really go on and on. Bitcoin is really huge right now, and that's another one, gaining popularity and traction. And so again, it's really important to understand that you have to start from the bottom. If you have a financial crisis or something impacts your health, and you don't have the right protection, you will regret it. You'll be forced to withdraw from your other investments that you were saving for later. There's also penalties and taxes that you pay when you early withdraw, so it really is just a double-edged sword. What do I mean by protection? What are we talking about with the proper foundation? Basically, there are three types of protection. We'll be starting with the pink bubble, which is labeled term. So term protection is basically temporary short term, just as it pretty much reads. It'll be for a short, specific amount of time, typically 10, 15, 20, or 30 years. So 10 years would be, of course, a little bit cheaper. And after that time, costs will increase. As we see over here, I'm just going down the list. They're temporary, they're low cost, they've got increased premium after a certain amount of time. They've got a fixed expiration date. There's no cash value for them. If you decide that you want a specific amount of money, it will stay constant and won't change. If you want to make it permanent, you definitely can convert it to a permanent term, which, as you can see, is to the right of the short-term one. You can also blend the two as well. So it really just depends on what you need. So permanent, similarly to the name, represents that it would be permanent protection for you. Typically is a higher cost, and that cost will never, but it will never increase once it's set. So we've got fixed premium. That'll be your payments every month will remain the same. In that kind of plan, they do tend to have cash value and growth in that area. There's an increasing death benefit. There tends to be, always increasing over the years. While you're still alive, you'll be able to use the cash value funds that you have. And then that money is a tax advantage, actually, a tax payoff, a tax write-off, excuse me. So what are living benefits? So basically they're to help cover any critical illnesses. COVID is included in that, for example, cancer as well, a stroke, heart attack, any kind of critical illness a person can endure. Some kind of accident, some kind of chronic illness, like kidney failure, for example, long-term care needs, whatever those might be, etc. And so those are all included under living benefits, and all three of these combined together help you set your strong foundation with proper protection. And at OIC, we sit with our consumers and we make sure our customers, and we make sure that they've got the right protections for them. And we make sure that we have a custom plan for their exact needs. So it fits and is tailored to you. Whatever you need, we'll work with you, and we'll make sure that it's in line and aligned with your life and habits. So I've got to admit a little something to you. I did start my financial planning upside down, or backwards, if you will, as I mentioned, many people often do. I started it with investments. I still didn't fully understand interest and how it worked and how it helped my money grow. And so I'd love to share this tip with you so that you don't make the same mistake, because this honestly was a game changer. So this is called the Rule of 72. Maybe you've heard of it. It's from a pretty famous scholar, a genius, Albert Einstein. So he came up with the Rule of 72, but maybe if you've never heard the rule before, you might be wondering what it is. It's pretty easy to understand. Essentially, the rule basically means that you take the number 72 You divide it by the interest rate. What's left is how it will show you how long it will take for your money to double or triple in growth. So imagine if you understand that, you can figure out anything. You can figure out how long it will take for your money to grow for any goal that you might establish or for any investment that you have. Can you retire on time? Will you have enough funds? This rule will help you. So let's say we've got 1% interest. So say you've got a savings account at your regular bank. And honestly, I have to tell you, my bank gives me like 0.05% for interest. It's really not that great. But when you go to Bank Rosemary, I'll give you 1%. All right, so come to my bank. So we've got examples of 29-year-olds. They've all started with $10,000 at different rates. Now, if you remember, 29-year-old with $10,000, that's a celebration because not many millennials save. But how do we make that money grow? So with 1% interest, what we're going to do is look at the math, and it's going to take 72 years, right? So 1 goes into 72 times, which means we've got 72 years at that 1% interest rate. So it means that I've got $10,000, and it would take me until I'm 101 to get $20,000, which is a little ridiculous, right? Now let's look at a 4% interest rate. So this is the average of 401ks, 403bs. And it would take about 18 years at a 4% interest rate to double or to triple. A lot of people do tend to choose this retirement option. And I'm wondering if you think this will help you retire by your retirement goal, by the goal you set for yourself. So just think about those numbers. Let's move to 10%, excuse me. If we notice, we've got $10,000 at 29, excuse me. And we have a 10% interest rate. It'll take 7.2 years. So you can see the math and what you'll save. And all of these people are the same age when they invest, but the only difference is what? The interest rate. That's the only difference in how they invest, or excuse me, how they save. It's important for us to be financially accountable to our money and our budget, and to the point where you understand where your money is growing. When's the last time you took a really hard look at your finances, especially when it comes to interest and interest rates with savings? Does it match your financial planning goals? Are you earning what you want? And again, as soon as I learned this rule, I opened up my account and I analyzed everything, my Fidelity account for my retirement, and I looked over everything. And this was really inspiring and helped me understand that there's different ways and better ways to save. And so sharing it with friends and customers is something I'm happy to do. And this is one of my a huge passion of mine, to be an advocate for everyone to become accountable to their funds and their goals. And you work hard. You should get what you want. Make sure that your money works for you. You work for it, make it work for you. Now that you know how to take a hard look at interest, let's talk about investment risk. So we're going to keep the same number, $10,000. If you lost 50% of that money, we know that it would whittle down to $5,000. That's a 50% loss. Suppose the stocks increase by 50% and you have a 50% return. You'll only end up receiving $7,500. Remember, it would take 100% of the growth to get back to that $10,000 that you originally invested. But who would ever invest 100% of their money? or to, excuse me, who often gets 100% of a return. So honestly, it typically takes double the time, and it is a little bit worse than we think, or double the money to receive what we want. So in that way, you have to pay double to make up for the loss from the market if the stocks were to plummet. So now that we've talked about our risk, let's talk about where your money can go. In noticing interest rates and thinking about the options and balancing your risk, considering all of your choices, we come to these three here. So we've got fixed accounts or fixed rates. So those might be bonds, savings accounts, CDs, which are typically a lower interest rate. So all the money's right there. There's no surprises, but there's not a lot of risk either. And the cost of living in the US, when we take that into consideration, it's on average about a 3 to 4% increase annually just for cost of living. And so fixed accounts tend to not even be enough to cover cost of living. Over time, you will actually end up losing value with the money that you've invested. The dollar amount will remain the same, and in that way, there's less anxiety, but you won't have any increases and you will potentially have losses. Second is variable. So those would be stocks, real estate, mutual funds, IRAs, Roth IRAs, etc. There are a lot included in this. And a variable, it varies just as in its name, correct? So it could grow, it can increase, but you could also lose everything. So it's a little more risky in that way. The last that we have is index. So index has a floor of 0%. So basically it means that you are guaranteed to never lose money. Unless, of course, like in the variable account where you can kind of have unlimited growth, you can't have that in index. Where you can't bottom out, you will also have a cap. And typically the cap is between 10 to 15%. So as you can tell, nothing is perfect. Nothing is too good to be true. Everything has risk. Everything has pros and cons. It's all balanced. It's really important to sit down with a professional who understands this to help you look over all of your goals, all of your finances, all of your plans, what you have, what you want, what you need, and then establish a plan based on what's best for you. And it can be a mix of these approaches, but we'll tailor it to you.
Great. So we've learned about what kind of interests that will help you achieve your goals and the different types of options for you to grow your money. And now, what about taxes? So as you know, the government always has a claim on some of our money. So it's just true. And sometimes taxing, you could get taxed now as opposed to later. And so for the types of accounts that get taxed now are savings accounts, CDs, stocks, or bonds. Those you pay tax, and as you grow or as your money grows, the interest you accumulate is taxable. You have to pay tax on that, and that's what's considered capital gain taxes. Some people would say, I have to pay tax twice, which, is just part of making money in the US. There are other types of savings that are actually tax deferred or taxed later. And it's not tax free or tax never. You do have to pay taxes on it. It's just at a later time. And what this could look like is before your paycheck gets taxed, you can set aside some money to go to a pension, a 403b, a 401k, or even an annuity or a traditional IRA. And when you're ready to retire at 59 and a half, that's the turning point that the government looks at to start withdrawing on your money. The government, the IRS, will withhold taxes on your gains. So the tax amount is about 22%. And so when you withdraw your money, Uncle Sam is ready and eager and waiting for all of you to retire so it can take that 22% a month of your gains on your retirement accounts. And then lastly, there's an account called tax advantage types of accounts. So for those that like tax advantages, like myself, this might be appealing for you. And what that means is you pay the money that you earn, you pay tax on it in full, and you go ahead and invest it into any of these types of accounts. So an individual retirement plan, a Roth IRA, or a 529 account, which is typically for a college savings account. There's another account that I left out, which is an HSA account too. So a health savings account does fall under this category as well. And so remember, this comes after taxes are taken out of your paycheck. And as that money grows and accumulates based on interest rates, come time to withdraw that money, you don't have to pay tax on it ever again. And so what that means is that falls under the tax advantage category. So on this slide, at our Infinite Company, it is our goal to provide support through a platform that provides and works with various companies to provide different types of solutions tailored to our clients achieving their goals. And most importantly, we really want to empower people to start learning and taking control of their financial accountability into your own future. And I know we have a lot of resources and information. There's information available on YouTube and podcasts and books that you can learn from to take control of your financial health. But one of the key things is that you take the first step. And the decisions that you make, the actions that you make, will determine what you do tomorrow. And so make smart ones. So thank you so much. That concludes my presentation. I hope that actually was informative and inspiring and can give you the tools to start taking control of your financial goals. And if you want to know more about financial education that we provide, like credit education, mortgage education, setting up emergency funds, student loan, in different ways and tools to help navigate this crazy financial world, we would love to help you. And we help our clients through using sign language.
Thank you, Rosemary. We do have some questions from the audience. We'll go all the way back to the beginning. One person asked, how are the 55 plus group able to save over $300,000 or more compared to the two other groups? How were they able to do that?
So in my experience, where I've seen that to be true is that age group is more able to live within their means. And so they're less likely to have a lot of other debt, like student loan debt, which is one of the biggest battles for people in those other categories, in the 36 to 50 age group. So they don't have that battle that the other age groups have. And also, they typically have paid off their house early on, and they're less likely to buy a newer home later in life, closer to retirement age, which allows them to put more of that money in the retirement category.
That's great. Thank you. What is the national standard for debt to income ratio? For example, limits of our annual incomes on our debts.
So really, that's an awesome question. So we really are diving deep into that question in our credit education workshop that we offer. And what I can say is the rule is 30% of the 30% of your credit usage, or your usage of your credit limit, is that ratio. So for example, so that's for keeping your credit score great. So if you were to buy a house, or something where you need credit, where you get approved for a loan, lenders will want to see that you have a less than 30% that income to debt ratio. That's typically the amount. So one of the ways easy to remember that is that if you think about your usage of your credit, 30% of that, or your total income to debt ratio, is also 30%. So that 30% is a good number to remember for that ratio.
Perfect. Do you have a chart of the power of compounding interest for those people who are starting at a much later age?
Yeah, I can share where I use that for our financial presentations. I can share that. I'd be happy to do that.
Okay, great. Thank you. And what are the annual limits on a contribution to Roth IRA?
That's another good question. So it would depend on where you are funding from. So typically the limit is $6,500.
Okay. And why is there a distinction between tax later and tax advantage, for example, 401k versus Roth IRA?
So when you set up a 401k, you have to remember that that money is pre-taxed to fund. So what that would mean is when you're ready to withdraw, you are withdrawing on money that's never been taxed before. So you have to pay taxes on that. When you set up a Roth IRA, it's on money that you already have paid taxes on. And when you withdraw, you don't have to pay taxes on that. So a lot of people think that their tax rates will go up in the future. So right now, the tax ratio is at 22%. And so if you want to be in that tax advantage category, you have more control over the tax later in life. And that's why a lot of people would want to use the tax advantage types of accounts, like a Roth IRP, or there are a few others in there, but that just kind of give you more control of their money when they really need it. So again, it's looking into the future and determining that that's something that fits you. So when you open an account, you'll be able to see it's the question about what comes in a tax later versus tax advantages. Where are you getting that money from? So a 401k doesn't actually show you, when come time to take out on that. That's not going to be the exact amount you'll get. You'll have to pay taxes on that by the time you start withdrawing on the tax later accounts. I hope that kind of clears it up, because if it doesn't, because that's actually a really good and in-depth question that requires some time. I would love to maybe reach out to the person who asked that question through email. I'd love to explain a little bit more about that.
Okay. We'll put your email in the chat for people to reach out, and I can let you know who this particular person was, because I think they'd love to have a conversation with you based on some of the questions they're asking.
I'd be happy to.
Another question is, do you help people make investments and do the investing part?
So I love to talk about investments. And if my clients already have investments and do not understand, I would provide education and resources on the products that are the financial products that they already have. If my clients want to start saving for the future, what we do is, this is a really important part of the process where we look at the income and DEX. In the X curve slide that I showed earlier, we want to make sure that the accepted risk is compatible for their goals and their future plans. We will help them with that.
Okay. And what do you think contributes to people mishandling or mismanaging their resources?
Yeah, that's, I think about probably the biggest thing would be the lack of education. This has the biggest impact, and the lack of exposure. So to get that exposure and to really understand what's the cause, and then that allows you to then ask the questions of what do you do and where you go, because a lot of people who might have taken a class, or even my own clients, are trying to learn but still did not move forward with that. So when they come to me, so while they're on this journey of learning, and they actually get to apply what they've learned right away. So it's not just a lack of knowledge at that point or a lack of education. It's where can you actually go to implement what you've learned as a solution. So sometimes that's where accessibility issues come up, but we help our clients at that point, because it's really important to have, like a minimum of $50,000 to $250,000 to actually meet with a financial planner. And we typically don't do that. So we allow the opportunities to sit down and learn, to see the potential of what's possible. And then if they are a good fit, we can, move forward with that. But everyone can start learning and know what the best next steps are. And sometimes that's just starting up an emergency fund, and that's okay. So there's so many different possibilities.
Absolutely. And the last question is if you have any thoughts on Bitcoin. That seems to be pretty hot right now. What do you think are the long-term prospects of Bitcoin?
Yeah, I know that gets me excited. It's a very hot topic. It's the future, really. And I hope that our youth really start studying Bitcoin, electronic currency, more in depth, because it is the future. And I encourage everyone to just start by reading material resources about Bitcoin, and just get started. by being exposed and learning as much as you can about it. You know, don't let yourself get overwhelmed, I would say. And, you know, I love it. And that's what I can say at this point.
Perfect. And I think that about does it for our questions. Unless anybody else has any other questions you'd like to send me.
Okay, this is Kristen. I just wanted to thank you, Rosemary, for presenting for us today, and also for Byron and Rachel interpreting for us today. We really appreciate it, and I hope everybody enjoyed this as well. Again, if you have any questions, feel free to reach out to us at greaterrochester.score.org. Feel free to also sign up for a free and confidential mentor. We're here to help you with your businesses as well. So thank you again, Rosemary, Byron, and Rachel. We really appreciate it. And have a good day, everyone.
Thank you so much. Yes, have a great day. Thank you for joining. Take care.